Oil just collapsed on the biggest inventory build in 3 years, but here's what everyone's missing. The EIA dropped a 17.4 million barrel surprise. Brent at 87. WTI at 81.27. But the Strait of Hormuz is still choked. 4.9 million barrels per day versus 21.6. I've seen this setup before. The oversold bounce is coming, but you need the exact levels. I'm watching 86.50 on Brent for the long entry and 88.50 for the short fade. The situation in the Middle East just took another twist, and oil is feeling every bit of the tension. Brent crude at $87.07. WTI at $81.27. But here's the thing, I'm not just looking at the price. I'm looking at what's happening beneath the surface, and what I see right now is a market that's caught between a massive supply shock and a geopolitical flaw that refuses to break. Let me be blunt with you. The Energy Information Administration dropped a bombshell yesterday. A 17.4 million barrel crude inventory build for the week ending August 7th. That's the largest single-week commercial stockpile surge since January 2023. Analysts were expecting a 1.4 million barrel draw. They missed the mark by 16 million barrels. That's not a miss. That's a market dislocation. And it hammered the complex hard. Brent dropped $1.56. WTI got crushed by $2.18, a 2.6% decline. Now, before you start piling into short positions, I need you to understand something I've learned from 20 years in this market. When you see a headline this extreme, the initial move is always emotional. The smart money waits. They let the retail traders panic, they let the algos trigger their stops, and then they step in. And right now, I'm seeing the early fingerprints of that exact playbook. My weekly verdict is cautiously bearish with a high probability of short-term mean reversion. Brent's monthly trend is still bullish at plus 3.39%, but the weekly trend is showing clear bearish exhaustion. The daily trend is strong bearish, and the 4-hour chart shows a breakdown structure that's about to test critical support. I'm watching $86.50 on Brent and $80.40 on WTI as the first major downside pivot zones. If those levels break, we could see a cascade down to $85 and $79.80 respectively. But if we hold, the geopolitical premium will push us back toward the daily pivots at $87.80 and $81.50. Let me walk you through the technicals starting from the weekly time frame because I want you to see the bigger picture. On the weekly Brent chart, the price action has formed a clear shooting star candlestick pattern after reaching the $90 zone. The momentum divergence is glaring. Price made a higher high, but the RSI on the weekly made a lower high. That's the kind of divergence that's led to major reversals in the past. I've seen this exact pattern 3 times in my career. Twice it led to a violent 5 to 8% correction, and once it got completely steamrolled by a geopolitical event. So we need to treat this with respect, not certainty. Coming down to the daily time frame, both Brent and WTI are hugging their 50-period exponential moving averages. Brent at 87.20, WTI at 81.10. The fact that price is sitting right on these levels tells me we're at a decision point. The 50 EMA has acted as dynamic support for the last 6 weeks. If we break below and close under it, that's a sell signal that institutional traders will act on. The ADX reading of 18.4 confirms what I'm seeing. There's a temporary loss of the preceding macro upward trend momentum. The trend is losing its grip. The MACD on the daily is telling a bearish story. The main line crossed below the signal line at -0.42. That sell signal is active, and it's gaining steam. The histogram is expanding to the downside. This isn't a false signal. This is momentum rolling over. But here's the nuance that most retail traders miss. The CCI reading is at -124.5, which is firmly oversold territory. And the Williams %R is at -82.1%. The market is extended to the downside in the short term. That doesn't mean it can't go lower, but it means we need to be aware that mean reversion is coming. It's just a question of whether it comes now or after another leg down. On the 4-hour time frame, the breakdown structure is clear. We lost the key support at the daily pivot points, 87.80 for Brent, 81.50 for WTI. Those levels are now resistance. I'm watching the 4-hour Bollinger Bands, which are expanding rapidly with the ATR at $2.10 on Brent and $2.35 on WTI. When volatility blocks this wide, you need to respect that your stops need to be wider than usual. I'll show you exactly where I'm placing my stops in the trade setup section. 1 hour chart is showing consolidation at the lows. This is classic post-implosion price action. The sellers hit hard, the stops get triggered, and then we sit in a tight range while the market decides the next direction. I'm monitoring the 1 hour RSI, which is creeping back up from 32 toward 40. If we see a bullish divergence on the 1 hour, lower lows in price but higher lows in RSI, that could signal the beginning of a counter-trend bounce. That's where the scalpers will feast. Now let's talk about the fundamental driver, because this is where the real story lives. The EIA inventory build was shocking, but it wasn't caused by domestic overproduction. Import arrivals compressed by 1.77 million barrels per day. That means the headline number was about timing and logistics rather than a fundamental surplus. The actual supply situation through the Strait of Hormuz is still catastrophic. Flows dropped to 4.9 million barrels per day in the second quarter of 2026 from 21.6 million barrels per day in late 2025. That's a 77% reduction. The physical deficit is real. It just hasn't shown up in the inventory data yet because of the way imports were scheduled. The demand side is where the real pain is coming from. The International Energy Agency just projected that global oil demand will contract by 1.6 million barrels per day in 2026. Demand destruction driven by elevated fuel prices and economic stress in Europe and Asia. OPEC followed suit, cutting their growth forecast to 580,000 barrels per day from 780,000. Those are significant downgrades. The consensus is clear. The world is using less oil at these prices, but here's what stands out to me. The geopolitical premium from the Strait of Hormuz blockade is still priced in, but the market is starting to discount it. Peace talks between the US, Israel, and Iran are deadlocked, but container shipping exclusions are stabilizing. The market is beginning to price in a scenario where the blockage persists but doesn't escalate into a wider regional conflict. That's a dangerous assumption, in my view. One incident, one missile strike, one tanker attack, one breakdown in negotiations, and this geopolitical premium reprices instantly. Today's event calendar gives us two key data points. At 1700 GMT, the Baker Hughes rig count. I'm watching this closely for signs of US shale capacity expansions. If we see an unexpected jump in rig additions, it will add bearish pressure because it signals that US producers are responding to the higher price environment by increasing supply. At 1930 GMT, we get the CFTC Commitments of Traders report. This is the institutional positioning update. I want to see whether hedge funds are capitulating out of long contracts. If they are, the sell-off has room to run. If they're holding or adding, we are near a bottom. Now let's get into the setups that I'm actually trading over the next 24 hours. I'm going to give you 2 scalp setups and 1 swing trade. These are based on the current technical levels and the ATR-based volatility adjustments that I've calculated for today's session. Don't miss out my attached trading cards at the end of this video. Scalp setup number 1 is the long scalp, targeting the oversold bounce. I'm looking for a trigger range on Brent between $86.50 and $86.70. For WTI, my trigger range is between $80.40 and $80.60. Confirmation requires a 5-minute candle showing a bullish pin bar or clear volume exhaustion closing near the S1 support level. Target profit for Brent is $87.30. WTI target is $81.20. Stop loss for Brent is $86.20. Stop loss for WTI is $80.10. The risk to reward on this trade is roughly 1 to 1.6. Scalp setup number 2 is the short scalp, fading the rallies. Trigger range for Brent is between $88.20 and $88.50. For WTI, between $81.90 and $82.20. Confirmation is a failure to break the daily pivot point on the 15-minute timeframe, accompanied by lower MACD highs. Target profit for Brent is $87.40. WTI target is $81.10. Stop loss for Brent is $88.80. Stop loss for WTI is $82.50. This setup has a tighter risk to reward around 1 to 1.2, but it's a higher probability trade because it aligns with the dominant bearish momentum. Before I give you the swing setup, I want to pause here because this next part is critical. If you're watching this in real time, I want you to do something for me. Open your charts, zoom out to the daily, and draw a horizontal line at the S1 support levels I just mentioned. Now draw another line at the R1 resistance. I want you to visually see the range. If we break one of these extremes, the next move is explosive. That's where the real money is made. And I'm positioning for that breakout. Swing setup is the bearish continuation strategy. Entry directive is simple. Sell on a confirmed 1-hour candle break and close below $86.50 on Brent or $80.40 on WTI. The trade logic here is capturing the secondary wave of the massive EIA inventory dump as European indices confirm global contraction fears. My take profit targets are $85.10 on Brent and $78.90 on WTI. Stop loss orders at $87.60 for Brent and $81.50 for WTI. That's a 1 to 1.7 risk to reward ratio. If we break down, we have room to run. But I also have to give you the geopolitical breakout strategy as a contingency because this market can flip on a headline. Entry directive is a clean 4-hour candle break and close above $88.60 on Brent or $82.50 on WTI. Trade logic is triggered only if headline news reports an absolute breakdown in Oman peace talks or renewed asset strikes near the Strait of Hormuz. Take profit targets at $90.50 on Brent and $84 on WTI. Stop loss orders at $87.40 and $81.20. The geopolitical trade is explosive. It could run $4 in a single session if the headlines align. Let me be candid about risk management because this is where most traders make avoidable mistakes. Because the structural energy deficit remains active. Through the maritime blockades, any aggressive headline can break technical structures completely. I cap my total per trade risk exposure at a maximum of 1% to 1.5% of equity. And I strictly move protective stop losses to break, even once my scale-out targets are reached. There's an old rule I learned from a floor trader in New York. You never let a winner become a loser. If you're up, protect it. Even if you have to get out and re-enter later, protecting capital is more important than maximizing profit. I remember a specific trade back in October of 2022. It was the same setup, massive inventory build, demand fears, geopolitical risk. The price dropped to the 75 zone. I had a short position targeting 72. I was up $2. I moved my stop to break even, and within hours, an OPEC Plus headline pushed price up $4. I got stopped out at break even while everyone else got crushed. That experience taught me that risk management isn't about being right. It's about being wrong well. Every profitable trader I know has a drawer full of losing trades. They just lose small and win big. For today's session, I want to reiterate the key levels you need to watch. Brent pivot is 87.80. The S1 is 86.50. The R1 is 88.98. WTI pivot is 81.50. The S1 is $80.50. The R1 is 82.49. If we hold above support, expect a mean reversion bounce toward the pivot. If we break below, look for the continuation play into the 85 zone on Brent and 79.80 on WTI. Looking ahead to Friday and the weekend, I'll be releasing a full weekly recap video breaking down the Baker Hughes data and the CFTC positioning. I'll also be doing a live Sunday evening preview before Asian markets open. That's where I'll refine these levels based on any weekend developments from the Strait of Hormuz negotiations. Before I close, I want to ask you something. What's your primary read on crude right now? Do you think the geopolitical premium will hold, or is demand destruction the dominant story? I want you to drop your key levels in the comments below. I'll be reading through them during the New York session, and if you've got a level that matches my analysis, I'll pin it. This is Trade Meridian Decoded signing off. Make sure you're subscribed with notifications on so you don't miss the next update. The situation in oil is fluid, and I'll be back with a live update if any major headlines hit before the next scheduled video. Stay sharp, trade smart, and I'll see you in the next one.